Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody. The big news from the last 24 hours is, of course, the court decision in Hong Kong on Monday ordering the liquidation of infamous Chinese developer Evergrande. Once China's largest seller of real estate, Evergrande has been trying to avoid formal bankruptcy since 2021, when it defaulted on $330 billion in debt and sent shockwaves through global markets. This liquidation order is a big deal, symbolically at least, but in practice it's not quite as significant as one might think. The market, after all, had long anticipated this, and so the damage was already largely done some time ago, and continues to be done. Of course, we are painfully aware that Evergrande was not a trigger to the current property crisis. It's only a symptom of a wider systemic issue. All that being said, the Evergrande liquidation is big news, and it's worth examining the salient points of this development here. After it was repeatedly unable to reach a deal with offshore creditors, a Hong Kong judge ordered the liquidation of China Evergrande, the world's most indebted property developer, yesterday, Monday. Justice Linda Chan said, quote, "Enough is enough," end quote, following months of delays of attempting to agree on a restructuring plan. The big question, of course, is whether Chinese authorities in the mainland will recognize the Hong Kong court's ruling and allow international creditors to seize assets of the company, which are mostly in the mainland. This will have significant implications for how international creditors will view the quality, value, and reliability of all mainland-based companies listed in Hong Kong. UK-based The Financial Times reports that in 2021, some jurisdictions in China agreed to recognize liquidation rulings from Hong Kong, but each case requires a separate application. Quote, "If creditors outside the country are unable to recoup some of their losses, it would be another blow to confidence in China's business environment. Foreign direct investment in China's economy fell by 8% last year, the first decline since 2012. End quote. Lance Jiang, a restructuring partner at law firm Ashurst, explained yesterday, quote, "The market will pay close attention to what the liquidators can do after being appointed, especially whether they can achieve recognition from any of the 3 designated PRC courts. The liquidators will have very limited powers of enforcement over onshore assets in mainland China if they cannot get such recognition." End quote. US-based Bloomberg writes that while Hong Kong's courts have issued at least 3 wind-up orders for other Chinese developers since the crisis began in 2021, quote, "None comes close to Evergrande in complexity, asset size, and the number of stakeholders. There are also few signs that the liquidation of smaller peers are moving forward much either. Hong Kong's insolvency procedures have limited recognition in China, whose courts may also appoint administrators in their own jurisdictions." End quote. Indeed, Hong Kong-based South China Morning Post, in an article called "Why Evergrande's Hong Kong Liquidation Order is Just the Start of an Uphill Battle for its Offshore Creditors," reports today that Glenn Ho, Deloitte's Deputy Value Creation and Crisis Group Leader for Financial Advisory, quote, "was pessimistic about the recovery rate for offshore creditors, as onshore creditors have priority to all the assets that are located onshore." End quote. The mainland courts, the outlet explains, could deem that mainland creditors are being treated unfairly, or the recognition violates the basic principles of Chinese laws, quote, "or that any recognition will offend public order or good morals," end quote. But however justified, if international creditors believe that their lawful interests have not been respected, then market sentiment will reflect this in the future. And it appears that in the mainland, the media is already playing down the Hong Kong order. State media writes that in response to the latest court decision, Xiao En, chief executive of Evergrande Group, expressed on Monday that the company, quote, "will ensure that apartments that are still being built will be delivered despite the liquidation order. The order would not affect the operations of Evergrande's onshore or offshore units," end quote. Professor Li Shuguang from the China University of Political Science and Law, speaking to Chinese financial media outlet Yicai, expressed, quote, "The winding up order against China Evergrande has limited direct impact on the rights and interests of domestic bondholders," end quote, adding, quote, "Domestic subsidiaries will continue to operate normally and orderly under the existing management structure and model," end quote. The following observation sums up everything fairly well. Quote, "The Evergrande liquidation sounds bad, but how this order flows back into the mainland where Evergrande's projects and assets are is very unclear. There certainly is no reason to expect this will cause any sort of panic or uncontrolled Lehman-like event. In many ways, it just confirms the reality that everyone already knows, that Evergrande is worthless, or worse. And the PRC regulators have to manage its orderly unwinding while ensuring that pre-sold projects are completed. Suppliers are paid and existing projects that Evergrande-related firms manage are maintained. Offshore creditors are likely at the bottom end of the list of priorities for grinding this Evergrande mess." End quote. Next up, we have two more developments to cover. But just quickly, guys, if you're enjoying today's episode of China Update, I have a huge favor to ask. That is to like and subscribe. 45% of regular viewers are not subscribed. These are people that watch most episodes anyway. It's only 2 clicks of the mouse, but this is a huge help for the channel. It helps the algorithm, which means this is shown to new people. And for those who want to go the extra mile and help keep China Update financially sustainable, the channel relies primarily on subscriber support from you guys to keep going. Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Yesterday, Monday the 13th chairperson's meeting of the 14th National Committee of the Chinese People's Political Consultative Conference, CPPCC, was held in Beijing. According to the official readout of the meeting reviewed and approved the decision to revoke Wang Xiaojun's membership of the 14th National Committee of the CPPCC. Wang was previously chief commander of the Long March 7 carrier rocket group and also the president of the China Academy of Launch Vehicle Technology. No reasons were given for the move, but it's likely Wang was involved in the investigations currently moving through the PLA rocket force, which has taken out many current and former high cadres in recent months. Wang's removal from the CPPCC marks the latest sign of turmoil in China's broader military-industrial complex and defense establishment. Beijing has now unseated at least 16 senior military figures in the past 6 months, all amid reports of corruption probes in the People's Liberation Army generally, and the rocket force in particular. As such, we note the development here and move on. Finally for today, in a blow to Moscow's plans to secure a new market for the gas it previously sold to Europe, construction on the mega pipeline connecting Russia's western gas fields with China is expected to be delayed. Speaking to UK-based The Financial Times, the Prime Minister of Mongolia warned that the Power of Siberia 2 pipeline, which will cross Mongolian territory, will be delayed, saying that Russia and China are yet to agree on critical details of the massive infrastructure project, and expressing, quote, "Those two sides still need more time to do more detailed research on the economic studies," end quote. Construction is supposed to begin this year, but that doesn't appear to be happening. The outlet explains that the 3,550-kilometer pipeline has been a priority for Moscow for more than a decade, but gained greater importance since Europe curbed its imports of Russian gas in response to the full-scale invasion of Ukraine in 2022. Russia's Deputy Prime Minister Alexander Novak wrote in the state-run magazine Energy Policy last Thursday that the timing of construction will be finalized, quote, "after signing binding agreements with Chinese partners," end quote, suggesting that these agreements have yet to be signed. We've been following this project closely on China Update. We remember that every time Putin and Xi have met, the former has pushed for the pipeline, with the latter rather uncommitted. Both parties know that Beijing has a lot of leverage in the negotiations of this mega project. China already receives gas from eastern Russia through the first Power of Siberia pipeline, which began operating in 2019. It carried approximately 23 billion cubic meters of gas last year and is expected to reach full capacity of 38 billion cubic centimeters in 2025. The Power of Siberia 2 will bring an additional 50 billion cubic centimeters of gas to China from fields in the Yamal Peninsula in western Siberia, which previously served Europe. This is still much less than the 150 billion cubic centimeters of Russian gas a year Europe used to buy before the war in Ukraine. The Financial Times explains in a separate report that Russia's state-owned Gazprom started a feasibility study for the project in 2020 and wants the pipeline to be operational by 2030. It hopes China can replace Europe as the biggest export market for its gas. Sergei Vakulenko, a former strategy director for Gazprom Neft and a senior fellow at the Carnegie Endowment for International Peace, said Russia was likely to be seeking better financial terms from China than it had achieved for the Power of Siberia 1 contract, adding, quote, "On the one hand, it's a no-brainer for the Chinese. They should have this gas. On the other hand, there is Russia with stranded gas, lots of it, and which wants better terms. I guess it's a bit of a horse trading at the moment," end quote. Wei Song, a senior analyst with Rystad Energy in Beijing, told the Financial Times that local industry in China are hoping to see the pipeline beginning operations from 2030 to meet rising Chinese demand, expressing, quote, "Although prices for piped gas have increased in the past couple of years, they are still much lower than liquefied natural gas imports. In the long term, China needs both to keep gas supplies diversified. This is a very important part here," end quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you all tomorrow.